Many people experience a noticeable increase in financial pressure as the end of the month approaches. This phenomenon, often termed month-end stress, is a recurring cycle tied directly to the structure of personal cash flow. The core reason is a timing mismatch between income and expenses. Most individuals receive their primary income on a monthly or bi-weekly basis. However, expenditures are often spread throughout the month with a significant concentration of major payments such as rent, mortgage, and utility bills falling due around the same time, typically at the end of one month or the beginning of the next. This creates a predictable pattern. In the days following a paycheck, a person's bank account balance is at its highest. This period can create a sense of financial comfort as the month progresses. Daily living costs, discretionary spending, and smaller bills gradually deplete these funds. By the final week, the remaining balance may be significantly lower, just as the largest and least flexible financial obligations become due. It's this predictable squeeze that generates anxiety. The stress isn't just about a lack of money in absolute terms. It's about the perceived scarcity of funds right when they are most needed for essential payments. This timing creates a psychological burden, as individuals must carefully manage their remaining cash to ensure they can meet their commitments without falling short. Another contributing factor is what behavioral economists call mental accounting. People often mentally categorize their money into different buckets. For example, they might have a mental account for groceries, another for entertainment, and a separate one for bills. Early in the month, when funds are plentiful, the lines between these mental accounts can blur. An individual might overspend on non-essential items, borrowing from the mental account they had implicitly reserved for future bills. They may not track this internal borrowing precisely. Consequently, when the end of the month arrives, the funds they thought were available for bills have already been spent elsewhere. The realization of this shortfall leads to an abrupt and stressful recalculation of their financial position. It forces last-minute adjustments, such as cutting back on groceries or other variable costs, to cover fixed expenses. Budgeting behavior also plays a critical role. While many people create a budget, adherence can wane over the course of a month. A common approach is to set a budget at the beginning of the month, but fail to track expenses in real time. This is known as a passive budgeting style. Without consistent tracking, small, seemingly insignificant purchases can accumulate. A coffee here, a lunch out there, these minor expenses, when summed up, can create a significant deviation from the planned budget. By the time the end of the month is near, the cumulative effect of these small overages becomes apparent. The budget deficit materializes, causing stress as the individual scrambles to find the necessary funds for their major bills. This is different from a complete lack of budgeting. Rather, it is the gap between the budget plan and its execution that causes the end-of-month pressure. The nature of modern payment systems can exacerbate this issue. Automatic payments and subscriptions are increasingly common. While convenient, they can also lead to a sense of detachment from spending. Money leaves an account without the physical act of handing over cash or swiping a card. These recurring charges, which can range from streaming services to gym memberships, chip away at an account balance throughout the month. If not diligently tracked, the total outflow from these automated debits can be much higher than a person remembers. When they check their balance late in the month, they may be surprised at how low it is, triggering anxiety about upcoming manual payments like rent. The convenience of set it and forget it can obscure the real-time financial picture until a critical moment. Furthermore, irregular or unexpected expenses are a constant feature of financial life. A car might need a repair, a minor medical issue might arise, or an urgent home appliance might need replacing. These costs are, by definition, not part of a standard monthly budget. When such an expense occurs mid-month, it forces a difficult choice. The individual must either draw from funds earmarked for end-of-month bills or use savings, if available. If they dip into the funds intended for rent or other major obligations, they are essentially creating a future problem for themselves. The stress of that decision and its consequences becomes most acute as the payment due dates for those major obligations loom. The financial cushion that existed at the start of the month is gone, replaced by a deficit that must be resolved under pressure. Income volatility is another significant driver of month-end stress, particularly for freelancers, gig economy workers, and those with commission-based pay. For these individuals, income is not a fixed, predictable amount that arrives on a specific day. It can fluctuate from month to month. This makes planning extremely difficult. They may base their spending on an optimistic income projection that doesn't materialize. Or, a delayed payment from a client can mean that expected funds simply aren't there when bills are due. This uncertainty creates a persistent low-level anxiety that spikes dramatically at the end of the month. They face the same fixed expenses as salaried employees, but without the certainty of a corresponding fixed income, making the month-end financial reconciliation a particularly stressful event. Psychological factors also heavily influence the experience of month-end stress. The concept of scarcity mindset describes how the perception of having too little of something, in this case, money, can impair cognitive function. When people feel financially squeezed, their minds become preoccupied with the immediate problem of making ends meet. This intense focus can lead to poor decision-making and heightened anxiety. It becomes harder to think clearly about long-term financial planning or to find creative solutions. The stress itself consumes mental bandwidth, making the problem feel even more overwhelming. The end of the month becomes a period of intense cognitive load, where every financial decision feels critical and fraught with risk. The societal pressure to maintain a certain lifestyle also contributes. There is often a discrepancy between the lifestyle people feel they should have and the one their income can realistically support. This can lead to overspending on discretionary items throughout the month in an effort to keep up with social norms or personal aspirations. The financial reality of these choices becomes unavoidable at the end of the month when the bank balance is low and essential bills must be paid. The stress is then a result of the conflict between lifestyle choices and financial constraints. This is not necessarily about extravagant spending, but can be as simple as regularly dining out with colleagues or buying new clothes to fit in at the workplace. The structure of credit and debt in the modern economy is another piece of the puzzle. Many people use credit cards to manage cash flow gaps. They might pay for daily expenses on a credit card, intending to pay off the balance when their salary arrives. However, this can create a cycle of debt. As the month ends, they may only be able to make the minimum payment on their credit card bill after covering essential expenses like rent. The remaining balance accrues interest, increasing their overall debt load. The next month begins with a slightly larger financial burden than the last. Over time, this creeping increase in debt makes each month end more stressful than the one before, as a larger portion of their income is required just to service existing debt. In summary, month-end financial stress is a multifaceted issue rooted in the fundamental structure of how people earn and spend money. It is a predictable consequence of the mismatch between the timing of income and major expenses. This core problem is amplified by common human behaviors like imperfect budgeting, the psychological effects of scarcity, and the use of mental accounting. Modern financial tools, such as automatic payments and credit, while offering convenience, can also obscure the real-time state of one's finances and contribute to a cycle of debt. Finally, external factors like income volatility and societal pressures add further layers of complexity and anxiety. Understanding these interconnected factors provides a clearer picture of why, for so many, the end of the calendar month is consistently associated with a period of significant financial and psychological pressure.